Welcome back to Daily Day Trades YouTube. It is my favorite time of the year, and we all know why. It is earnings season, baby. Earnings are an awesome way to get some huge option trades. In one quarter, we had 4 or 5 trades over 250% in 1 week. So I'm going to go through a few methods to set yourself up for big wins. In this video, unless I mention otherwise, we're talking about trading options and not shares. Keep in mind that these trades carry an extreme amount of risk, and when it's done incorrectly, it's a really good way to blow up an account. The first thing to know in trading earnings is the difference in prices. I can't tell you how many people get screwed over because they didn't understand how options are priced. You may or may not notice that these contracts are much more expensive in the days leading up to an earnings report, and that is because implied volatility of the underlying stock goes up significantly in anticipation of this larger move that we're going to get. For this, we're not going to go into tons of detail on how implied volatility works. The only thing that needs to be understood for now is that when you're buying an earnings trade, being right is not always enough to make money on it. You have to be right in a statistically significant way. Since the market is expecting a big move, there's a projected move already priced into these contracts. So here's the option chain for Amazon, which reports this week. Look at these contracts out of the money down here. We're trading at 102.5, yet the 105 calls are almost $300. So you're paying $300 for something that's out of the money and it expires in just a couple days. Obviously, same goes for puts. Let's say you buy those 105 calls and Amazon exceeds expectations. Everyone's very excited, but the stock only goes up 2% and now it's trading at 106-ish. For those calls to be worth what you paid by the time that they expire, the stock needs to be worth almost $108. So even though they did well and the stock went up, altogether you were right, but it didn't go up nearly enough to cover the premium that you paid up front. Had this been a typical day without an earnings report, a 2% move overnight would be fantastic, and you'd probably be up in a solid 100% depending on the time to expiration. But in this case, the expected move was higher, and that means you're basically out of luck. I could go way deeper into how this all works, but I don't want to get bogged down with pricing when we're really here to talk strategy. If you want a video that's all about contract pricing, leave a comment and let me know. Now that we have a sort of basic understanding of why these trades carry more risk, we need to find a way to reduce that risk so that we're able to have a chance of hitting big numbers during earnings season. One way to do this is by finding a stock that everyone has high expectations for. Tesla is definitely guilty of this. And as analysts continue to hype up a company's earnings, you can actually make money without the stock even moving. The stock will stay the same, but the premium on the contracts will go up, meaning that obviously your position is increasing in value. It's the counterpoint to the previous example of implied volatility. If stock XXX has earnings on Friday and you buy call Mondays, the implied volatility may not be very high right then. As the week goes on and more people talk about the upcoming earnings report, expectations could change and people will start pricing in a bigger move. As they price in this bigger move, your contracts will go up even if the stock price stays the same, and we can sell some of those contracts prior to earnings to reduce the risk. Even better, sometimes this will double down where the implied volatility goes up throughout the week and the stock price gains momentum from all the earnings hype. In this case, you can see easily a 200-300% gain without even risking it on the earnings report. You can just sell it before it even comes out, wash your hands, move on. That may seem too simple, but it does happen all the time, and because of this, I'm always looking for companies to go on a run before they report. If you do it correctly, you can sell out of most of the trade and keep a couple contracts. Then, even if they go to zero, you still took enough profits to make a significant amount of money on the overall trade, and you still have a couple contracts left, which leads us into the next strategy. And in this one, we're only concentrated on getting free contracts. I'll give you a quick example of making a trade free. So on Monday, we buy 10 calls on ABC for $20 a piece. That makes our total amount for this trade $200. And on the very same day, ABC has a fantastic outing and it goes up 5%. The good day that ABC had raises the price of our contracts to $30 each, and now our trade is worth $300. So how do we get our free contracts? Well, we paid $200 initially, so we get that money back by selling at least $200 worth of our calls. In this case, we can sell 7 of the contracts for $210, and since we only paid $200 to open the position itself, this gives us a $10 profit overall, but the best part is we still have 3 of these calls remaining for the earnings report. And since we already paid for them with the profits that we have, they carry absolutely no risk. And I'm sure you can see why that's a good thing, because now we have a $90 trade that we already paid for going into this earnings report. And if it pops up, then guess what? We just made an extra couple 100% on a trade that technically did not carry risk for us at the time once we sold those other contracts. You can do this with smaller gains by spending more and then selling more, like buying $1,000 worth and then selling $900 worth when it's up 10%. You get your $100 profit that pays for your contracts, and you have a little trade going into the report. I do this with various trade amounts all the time, and it is very, very effective in setting up for big trades, and you have much lower risk. Another way to catch a big win is to find stocks that are aggressively oversold. So when something is way down in the dirt and nothing seems to be going their way, any sort of positive outlook from an earnings call is likely going to gap them up simply because there's nowhere else to go. There is a caveat though, you can't do this with companies that are actually crap. It has to be something semi-reputable where investors think it at least has a chance of bouncing back. If it's something that's at risk of being delisted or being investigated for fraud or something, no one's going to want to buy that no matter how cheap it is. So just because something is oversold does not mean that it's on a discount. A good example of an oversold stock that could jump would be something like NEO. Clearly it's trading at a discount. It's at a 52-week low, and it doesn't seem like it could trade a whole lot lower. It definitely could trade lower, but we know that there are usually a lot of eyes on NEOs, and some decent news from them could push this thing up, 20%, maybe more, pretty easily. Is it going to stay up 20%? Maybe, maybe not, but we don't really give a crap because we got it for earnings, and we're going to sell it the next day regardless of what happens. As a reminder, all the trades that I make are posted live every single day on these channels. We also have a swing trade portfolio that we're always updating, plenty of education that's constantly updated, and a lot of other things. If you're interested in that, there's a link in the description of this video that has more information. And if you sign up today, the 30-day free trial will cover all of earnings season, so that's good, and it's only $9 a month after that. Special shout out to everyone who's joined recently. We have a great group going, and it will only grow now that I made it basically free. Besides that, subscribe to the channel if you want to see more videos like this, and drop a like on the video if you enjoyed it. Thank you. I will see you tomorrow.